Hey everyone, and welcome. Today, we're diving into a real property puzzle. We're looking at one luxury apartment building in Kuala Lumpur that's somehow both a fantastic investment and a really terrible one, all at the same time. Yeah, you heard that right. So let's investigate the two very different stories of the Aria residents. So, right off the bat, here's the big question. How can a single property be a cash-generating machine for its owner while also, losing them a whole bunch of money? It just doesn't sound right, does it? But believe me, it's possible, and that's exactly what we're going to break down today. All right, so let's get specific. Our case study is the Aria Luxury Residence. And this isn't just some random building. Oh no. This is a super high-end freehold property smack in the middle of Kuala Lumpur's diplomatic enclave. We're talking embassies, big international companies. This location has some serious prestige. Okay, let's start with the good stuff. Part 1, the good story, and why some people see Aria as an absolute rental goldmine. Now, before we get into any numbers, we've got to get this one simple idea straight. I want you to think of a property like it's an apple tree. Okay? The cash you get from selling its apples every single year, that's your rental income, what we call rental yield. But the value of the tree itself, whether it's actually growing bigger and worth more over time, well, that's your capital appreciation. And these are two totally different ways to make money from the same asset. So, with that in mind, what kind of apples are we getting from this tree? An estimated 5.14% rental yield. Now, let me tell you, for a luxury property in a big city like KL, that is a very, very healthy number. That's a lot of cash flow coming in year after year. So why is the rental income so good? Well, it's kind of the perfect recipe. First, it's on rare freehold land. It's got massive facilities, plus fancy services like a concierge. But the real secret sauce? The tenants. There's the steady stream of high-paying embassy staff and corporate expats who want to live there. And to top it all off, it has these amazing unblockable green views over a golf club. And in a concrete jungle, that is like solid gold. And this really gets to the heart of its rental power. One analysis puts it perfectly, saying Aria has an enduring appeal to the niche expat rental market. See, its strength isn't trying to be for everyone. It's about being the absolute perfect choice for a very specific and very profitable group of renters. So it's a cash flow machine, right? Sounds like a dream investment. But hold on a second. We've got to turn the page. Now we look at the other side of the coin, the bad story, or what we can call the value trap. And this right here is where the story completely flips on its head. When it launched, units were going for about 1,800 Malaysian ringgit per square foot. Fast forward to today, and the median price for a sale is just 1477. That's a pretty painful drop. So if you bought this thing hoping your tree would grow in value, well, you've actually seen a big chunk of your initial investment just vanish. So what on earth went wrong? Well, it's a classic case of supply and demand, specifically a massive oversupply. There are just too many luxury condos being built in the city center, especially around the KLCC area. And when you have that much competition, prices for older buildings like Aria just get pushed down. Simple as that. And then you have the day-to-day headaches. The building is right on one of the city's busiest roads, Jalan Tun Razak. And when I say busy, I mean it. We're talking about roughly 4,000 vehicles whipping past every single hour during peak times. That's a recipe for gridlock traffic and a whole lot of noise. The marketing also seems to have stretched the truth a little bit when it comes to convenience. The ads bragged about a quick 5-minute walk to the nearest train station, but if you actually walk it, it's more like 12 to 14 minutes. Now, that might not sound like a lot, but for residents and investors banking on convenience, that's a pretty big deal. So let's just add this all up for a second. If you're an owner, you're facing some serious headwinds. Your property value is actually going down, not up. You've got to live with insane traffic and noise, and on top of all that, shiny new competitors are popping up all the time just down the road. It's a tough spot to be in. So, what do we have? Two stories that are completely opposite but both true. It's a rental success and a capital value trap. How do we make sense of this paradox? What's the final verdict? Well, it all comes down to one simple but incredibly powerful idea. You absolutely have to know your investment goal from day one. Look, it really boils down to this simple chart. If your main goal is getting a steady, reliable paycheck every month, cash flow, then Aria is a great fit. That high rental yield and the solid demand from expats means the money keeps coming in.
But if your goal is capital growth, if you're trying to buy low and sell high, then Aria is a really poor bet. All that competition in the market is just dragging its value down.
So the whole thing really comes down to this one crucial point. And honestly, this applies to any asset you ever think about buying. You just have to ask yourself one simple question. When I put my money down, am I buying the fruit or am I buying the tree? Knowing what you're really after? Well, that's everything.